Howdy, Jacob here. Today we're looking at Powell Industries in the electrical equipment industry, 3.5 billion market cap on 3.1 billion enterprise value. Growth of the business, if you just look at the last 3 years, looks wild, but it was looking pretty stagnant, actually declining a bit from 2015 to 2021. But they've hit traction, it appears, and have been producing immense margins, much higher than prior years in the decade before, or 5 years before or so. They've been paying a dividend out, and most recently it looks inconsequential to their earnings, but historically, there's a chance this dividend should have not been paid out. Return on invested capital recently looks very good because, again, earnings look absolutely massive, but historically it does look like it's more mid single digits. Electrical equipment industry, they, together with their subsidiaries, design, develop, manufacture, sell, and service custom engineered equipment and systems, include integrated power control substations, custom engineered modules. Okay. All right. Globally, founded in 1947 out of Houston, Texas. Balance sheet shows $350 million in cash-like products, no short-term debt, no long-term debt, 445 total in total liabilities. So hefty amount of cash on hand in relation to their no debt on the long-term and short-term side. Very positive. Income statement shows just 1% or so to R&D as an expense. Majority, a hefty amount, is going to be their cost of goods sold. So although their revenue is up a lot, their cost of goods sold is up a lot. Not as much though, so we do see a greater gross margin, which is positive. Cash flow statement shows a good production of free cash flow with capital expenditures not very grand. And so it looks like outside of 1, 2, 3, 4 years of the last 10, they did produce a good amount of free cash flow, and those have well exceeded the cost of those other 4 years that were down years. And majority of their cash flow is going towards a dividend and reinvestment, and clearly to a strong cash pile as well right now, since cash has gone from 37 million in 2018 to 315 million in 2023, 24. So they should be looking for things to do with that capital allocation, and it's all about the most advantageous use of your dollar. Is it most advantageous to buy the shares back? Is it most advantageous to pay it out in a dividend? Can you find opportunities to reinvest at well over 10%? That's going to be your best rate likely. And so this is going to be a business that they're going to have to allocate capital well with the money they have on hand. And if not, I'd rather them just give it to us as a shareholder, since they're not carrying any short-term or long-term debt and have no plans to do any acquisitions. Otherwise, I would very much hope that would get a good return on their investment. But again, use of cash is pretty much share repurchases, offsetting stock-based compensation, slightly amount or a little bit amount for reinvestment, and his dividend. So I think that's enough to me to start making some assumptions here on the revenue growth side. I mean, I don't know much about it given what I'm seeing here. I see the last 3 years have grown very impressively, and it wasn't necessarily due to acquisitions, possibly a little bit from investments, but still very impressive growth. I think 5% seems pretty reasonable to me. As for margins, I love that free cash flow is a bit more on the consistent side. I might be going with something like 7 and 9% for their net income and free cash flow margins. Share change pretty much just offset. We saw a little bit of stock-based compensation and a little bit of share purchases, so let's just assume that gets cut out. Terminal value for price to earnings and price to free cash flow with 5% growth rate. The return on invested capital is good recently. Can they sustain that? If they do, I think a little bit above market average or pretty close to market average historically is reasonable to me. and a dividend that they haven't really increased it much. So I'm just going to keep it how it is right now. And given my current assumptions, it looks to be a bit overpriced. To me, at this moment, if you really understand this business, you're confident that they're able to grow double digits for the next little bit, keep these margins. It might be a bit more of an attractive price at this point, but given what I'm seeing, given the long history that I saw, I'm not too eager to be putting in assumptions at the current last 3 years revenue rates. So either way, hope you enjoy this video and have a great rest of your day. Thank you.